So today I'll be talking about the dot-com bubble, what it is about, what really happened, how it affected the market, and how the market recovered. So, what was the dot-com bubble? Well, the dot-com bubble, also known as the internet bubble, was a rapid rise in US technology stock equity valuations fueled by investments in internet-based companies during the bull market in the late 1990s. So during the dot-com bubble, the value of equity markets grew, you know, exponentially with the technology-dominated Nasdaq index rising from under 1,000 to more than 5,000 within the years 1995 and 2000. In 2001 and through 2002, the bubble burst, with equities entering a bear market. Well, the crash that followed saw the Nasdaq index, which had risen five-folds between 1995 and 2000, tumble from a peak of 5,048.62 on March 10th, 2000 to 1,139.90 on October 4th, 2002. And you can see that it was reading here that it's 76.81% fall by the end of 2001. Most dot-com stocks had gone bust. Even the share prices of blue-chip technology stocks like Cisco, Intel, and Oracle lost more than 80% of their value. Wow. It would take 15 years for the Nasdaq to regain its dot-com peak, which it did in April 2015. So, what exactly, you know, was around this dot-com bubble, right? The dot-com bubble grew out of a combination of the presence of speculative or fad-based investing, the abundance of venture capital funding for startups, and the failure of dot-com to turn a profit. Investors poured money into internet startups during the 1990s in the hope that those companies would one day become, profitable and make investors and venture capitalists abandon a cautious approach for fear of not being able to cash in on the growing use of the internet. With capital markets throwing money at the sector, startups were in a race to get big fast. Companies without any you know proprietary technology abandoned fiscal responsibility and spent a fortune on marketing to establish brands that would differentiate themselves from the competition. Some startups spend as much as 90% on their budget on advertising. So here are some fast facts. Record amounts of capital flowed, started following the into the Nasdaq in 1997. By 1999, 39% of all venture capital investments were going to internet companies. That year, 295 of the 457 IPOs were related to internet companies. So, and here are some key takeaways, right? The value of equity markets grew exponentially during the dot-com bubble, with the Nasdaq rising from under 1,000 to more than 5,000 between 1995 to 2000. And how did the dot-com bubble burst? Right, that's a great question. The 1990s was a period of rapid technological advancement in many years, but it was the commercialization of the internet that led to the greatest expansion of capital growth the country had ever seen. Uh, Although high-tech standard bearers such as Intel, Cisco, and Oracle were driving the organic growth in the technology sector, it was the upstart dot-com companies that followed the stock market surge that began in 1995. So, the Nasdaq index, peaked on March 10, 2000 at 5,048, nearly double over the, prior year, right at the market's peak. Several of the leading high-tech companies such as Dell and Cisco placed huge sell orders on their stocks, sparking panic selling amongst investors. Within a few weeks, the stock market lost 10% of its value as investment capital, began to dry up. So did the live, blood of cash-strapped dot-com companies. So dot-com companies that had, reached market capitalization in the hundreds of millions of dollars became worthless within a matter of months. By the end of 2001, A majority of publicly traded dot-com companies folded and trillions of dollars investment capitals evaporated. Wow. So we can get to see the main um, ideas of this dot-com bubble, and let's take a look at the two main causes of this dot-com bubble, right? The factors that led to the dot-com bubble. There are two primary factors that was quite explained here, right? And the first is actually the use of metrics that ignored cash flow, right? So um, we were told that many analysts focused on aspects of individual businesses that had nothing to do with how they generated revenue on their cash flow. For example, one theory is that the internet bubble burst due to a preoccupation with the network theory. So, which started the value of a network increased exponentially as the series of nodes, computer hosting the network increased. Although this concept was, it made sense, it neglected one of the most important aspects of valuing the network, the ability of the company to use the network to generate cash and produce profits for investors. So this is the main reason, the use of metrics that ignored cash flows. So now here's the second one. The second reason is actually significantly overvalued stocks. So, in addition to focusing on unnecessary metrics, analysts used very high multipliers in their models and formulas um, by valuing internet companies, which resulted in unrealistic and overly optimistic values. Although more conservative analysts disagreed, right? Their recommendations were virtually drowned out of the overwhelming hype in the financial community around the internet stocks. Right. So the world's largest bank, HSBC Holdings, conducted research on the P&E, you know, ratios of newer tech savvy companies. According to their findings, these newer companies were overvalued by 40%. Wow. In fact, the only way these stocks could have been, properly valued would be if their revenues grew by 80% a year for 5 years. However, this would probably have been an impossible standard for any company to meet, given that even Microsoft only averaged a little over 50% a year. So now, let's key all this into the internet bubble 2.0. Some people are actually speculating that there are some, internet bubbles at the moment, and it seems as though perhaps the world did not learn its lessons, from the first bubble, and there could be another. The introduction of social media has led to a new internet obsession, which may be turning into another dot-com crisis. And four major players are contributing to this, for button.com search. And the first one is actually Facebook, right? We know Facebook. Facebook has been valued as being worth $84 billion and may be valued at $100 billion when the stock goes public, right? We already know it's public. And as well, the second one is actually Twitter. Twitter is another social networking company that is struggling to get by. Twitter has not found a meaningful method to earn a profit, even though it has more than 200 active users. In the meantime, it is kept afloat by contributions from investors, right? And in fact, Silicon Valley valuations put Twitter's worth between dollars to 8 billion, you know, dollars. And LinkedIn, LinkedIn as well is another one to look out for. LinkedIn stock was issued for $45 a share today. The stock is trading at more than $90, right? And another one is actually Group On, um, and that's it. So here's some main social media platforms that people are actually, um, making use of, that people think might actually be the dot-com bubble too. And how do we avoid this, avoiding another bubble? Popularity does not equal profit. Many companies are too speculative. Sound business models are essential. Basic business fundamentals cannot be ignored. Correction with the stock market is key, right? So, Just take a look at